Hi, everyone, and thank you for joining us today for our webinar, Making Sense of Credit Reports. My name is Kelly Blount, and I will be today's moderator. We have an exciting agenda planned for you today on understanding a credit report. With that, let's go ahead and get started. I'd like to turn things over to Todd Moore, Director of Education with Trinity Debt Management, to introduce himself and take us through today's presentation.
Well, thank you so much, Kelly, and thank you to everyone who is joining us again this afternoon. We really do appreciate you joining us as we continue the webinar series. Todd Moore with Trinity Debt Management, and today we have, I think, some great content to share with you. Often get questions about credit reports and the details within a credit report. So really want to we're going to take a deep dive today, get into some of those details, lay out the structure and the layout of a credit report, the history, how these reports are used in the market, and then ways that you can utilize these reports better to improve your credit history. And finally, if there's any issues with the credit report, ways to kind of dispute or clean up any errors that may be on the report itself. So let's get started. So when we think about credit reporting, one of the things that we have to think about is we often start with just understanding something about these three credit bureaus. A lot of questions oftentimes about the three credit bureaus. What do they do? What kind of information is collected? Kind of want to start there. So when we think about a credit report itself, most of us arrive at a credit report typically when we're looking for a loan. Sometimes we may be seeking housing of some sort or loan related, something that has to do with making some type of either a financial decision or what we might call a risk-based decision. That is, someone's going to either loan you money or you're applying for something or seeking employment, those sorts of things. So we come to credit reports for specific reasons. So often, we're going to be looking at information about our credit score itself. So when we start with credit reports, these reports are generated by the three credit bureaus to provide information to the market and to others who are going to make decisions, whether to lend you money, allow housing decisions, all those sorts of things. But we need information to make those types of decisions. And that's where we go to the bureaus and collect that information to figure out how to make the best decision moving forward. So financial institutions are going to be the folks who are going to use these reports and purchase these reports. You can also purchase reports. We'll talk a lot about that. But the beginning is always kind of financial decisions and how these reports are generated within the market itself. So insurance companies, employers, landlords, those sorts of things. That's kind of where we all start in this journey trying to make sense of credit reports. I've got this great timeline here that presented when we think about credit reporting and the history of reporting. How do we arrive at this? We all think about credit scores now and things just being auto-generated, three-digit numbers that tell us whether or not we get loans, or those reports allow us to move forward in different decisions. But we arrive at this process through a long history. And I thought I would start by just giving us some background, because I often get a lot of questions. Well, why is there three credit bureaus? Why is there only three, and what do they do? I won't spend a great deal of time here, but I think that you might find some of this interesting when you think about credit reporting itself. So, we think about all these different decisions that are made, whether it's lending or housing, all those sorts of things we talked about. There's a long history with how these credit reports and the data, how this all is generated through time. So if you think back, going back into the kind of mid-1800s, lending decisions, there's always been risk involved in any kind of financial transaction. But, when we think about the history of credit reporting itself and how we arrive at where we're at now, back in the good old days in the 1800s, we have to think about lending decisions just basically based on hearsay and vouching for someone. You would say this person has good character. We believe this person. If you're going to sell products or services to someone, this would be a good person to do that, to make those transactions with. Or if you're going to go into a business transaction or secure for risk or insurance, again, we don't have the automated type approach at this time. We're looking at simply just saying this person is of sound character. We know character and those things. We still look at some of those things when we look at credit reports, although it's not a function of scoring. But others may look in a credit report for certain things about employment or you being truthful and those sorts of things. So reports can be used from that. So it has a long history. A couple other things here when we look at Dun and Bradstreet. So if you're, we think about Dun and Bradstreet, these were folks who would early on in the market looking at commercial credit reporting agencies. So particularly those folks who were either entrepreneurs or going into business. Your Dun and Bradstreet folks are the ones that we're going to see commercial or business lines of credit done through a long history of Dun and Bradstreet being involved in the market. And then, we think about the three major bureaus. You start to see as you get into the early 1900s, this is where the three bureaus itself, which I find interesting, is where you start to see going from just this notion of character to where credit reporting is often now, rather than just being very local or based on character or making assumptions about someone and how they may function with a line of credit, that you see this with, you see credit reporting kind of move from a local to a regional kind of presence. And that's where we get the three major credit bureaus. So you think about kind of the Midwest, the East Coast, the West Coast, you start to see that as things are evolving through time, and this kind of answers that question, how do we arrive at these three major bureaus, Equifax, TransUnion, and Experian? We move from localized decisions to regional decisions. We began to have what was called the retail credit company, which will later become Equifax, again, moving to a regional as the market is expanding. We move from kind of agrarian into industrial in bigger cities in the 1920s. We got to make decisions based on risk. How do we expand credit? How do we use financial markets differently? This is where we start to use regional data. And then, moving forward, we start to see that FICO emerges in about the mid 1950s. And this is where you start to see the introduction of the master charge. The credit card market becomes popular. So this is post-war America after World War II. Think about the boom that takes place historically and economically after World War II. Here, what we're looking at is a massive expansion of the credit market. Everything from being able to purchase a home through a Sears catalog to being able to use plastic. That is, credit card market emerges in 1950, and needing to find some way to make decisions. We have to have data-based decisions of some sort. So FICO, which is Bill Fair and Earl Isaac and Company. So these are data analytic services that are created. They come up with scoring methods. Many of those methods based on the 5 factors of scoring are still with us today. Fair Isaac and Company. TransUnion goes from a regional to a large presence. And then, the rest is history at this point. So we have this large presence in the 1970s where a whole series of laws and consumer protections come in. We'll talk about that later towards the end of the presentation. But this is basically that background that oftentimes folks will scratch their heads and say, how do we get these three credit bureaus? What does it mean? What kind of information are they collecting? I hope that this gives you some indication that risk-based decisions and just thinking about risk has been around for a long time. And we've moved and innovated on how we make decisions in the market and how we expand lines of credit. Hope that short history gives you some background as you think about why we have three bureaus today. And we'll talk a lot more about details on what these three bureaus do. So how is information on these credit reports actually reported? Where do they get this information? How does this work? So when we think about credit reporting, again, the three major bureaus that we're talking about, and as that history shows, these are the three bureaus now. There are also bureaus that I did not list in the presentation: LexisNexis, other private companies that operate for alternative data sources. But in most lending decisions, we're looking at the three major bureaus. So Equifax, TransUnion, and Experian. That's the three that we'll be talking about primarily throughout the presentation. So again, lenders submit information, positive, negative information, to at least one of the three bureaus. Now, I want you to take note of this. So we get a lot of questions oftentimes, well, I found something on one report, it was not listed on the other report. Why? Why is that the case? Well, again, as I've shown here, there's a requirement to at least one of the major bureaus, but they don't necessarily have to report to all three, and they don't have to report at the same time. So you will find, and this is why it's so important for you to be, active in this process, monitoring your credit, and looking for information that's either incorrect or duplicate, those sorts of things. Folks that report, lenders, housing, they have to pay to report. So they will report to one. Most financial institutions were going to report to one, but again, they don't report to all. So you'll see variation on the credit report itself. And it's one of the reasons why when you go into a credit union or a bank that they'll do what's called a tri-merge. So they'll look at all three reports as opposed to just one. So again, what we're thinking about is risk. If we're going to make large financial decisions, you're going to borrow for a home, a car, a line of credit, we've got to cast a wider net, not just one, knowing that information may only be reported to one bureau. Banks, credit unions, making wise decisions about lending practices. We cast a wide net. We do a tri-merge across all three reports. That gives us the information that we need for making decisions. Okay, so when we think about other uses of how credit reports are used, there's certainly incentives for lenders to use these reports when they make decisions about expanding markets, whether it's through a credit card market. Sometimes you'll get a pre-qualification in the mail. Folks have bought banks, credit unions, financial institutions, insurance companies, they buy data from the bureaus. They want to see how to target folks within the market. It's called segmentation. I'll be talking about that here in a few minutes. But basically what we're trying to do is we're looking into the future. So we buy data. We're going to make some type of decision to try to expand to certain markets. We may be looking at expanding the credit card market in a certain zip code area. We may be looking for new insurance companies, customers within a certain area. So we need that type of information. There's an incentive for institutions to buy that data as they expand markets. So an additional use for how credit reports are used. And then consumers, we know how they use them. Creditor may delinquent accounts and their ability to obtain credit in the future. We know as consumers that those delinquent accounts truly matter. So to our detriment, we know that anything that's delinquent or in default or a charge off, those sorts of things, anytime that our accounts are becoming we have an adverse account on a credit report, we have to take steps to make sure that we either improve our credit history, dispute information that's incorrect, take steps so that we want active open accounts to show positive payment history. So we have incentives as well to use this information to obtain the types of financial services that we need. And then lastly, just looking for accurate information in the market, or for borrowers that are future business. We want to pool, banks and credit unions want to be able to lend money, expand financial markets to borrowers where there is a likelihood of repayment. So when we think about additional uses for how reporting is done, having credit reports that are able to be accurate and timely for lending decisions, obviously that becomes a financial tool that can be used to just expand financial markets, economic development, all sorts of uses there just by having those reports, knowing that the likelihood of giving to future borrowers, the likelihood of also being repaid. So those are just some of the ways that we use this type of information in the market. and how that information is also shared to the three credit bureaus. So again, I've talked a little bit about these three major credit bureaus. I think we're all pretty much aware of those bureaus. We've run into this through our borrowing practices through time, or if you're in the market right now, maybe you're even thinking about a new car or trying to purchase a home here this year. Certainly, we're going to be looking at these three credit bureaus. And if you've been part of the webinar series, you know that we take credit scoring, and I take credit scoring very seriously. So we've talked a lot about credit scoring through the webinar series. I will share with you that if you go back and look at the education link on the General Electric website, General Electric Credit Union website, you're going to find some great information there with many topics that are associated with credit scoring and the credit scoring model itself. We'll share a couple of those details with you today. But when we think about the bureaus, part of what you will find on a credit report is information about a credit score itself, and you'll find, we'll be talking today about what's called a beacon score, but FICO, Fair Isaac & Co. company, they're going to provide those scores to the bureau, and then that final product that you get, the report itself, all that information is there. So we're looking at identity, your overall credit history, your credit activity, information from public records. We'll go into some of these details, but we'll be looking at those key components, what I call the structure and form of the actual credit report itself. But that's when we generate reports, we know that the three bureaus rely heavily on scoring, and then that also is used in the market for all those other lending decisions that we talked about. Now, this point about information coming from different sources, this is where, again, this can be kind of interesting when you look at the three credit bureaus. You'll see in a couple slides that while FICO generates many different scores, so they'll generate scores, we'll be using a beacon for the Equifax, and there'll be some other scores used for Experian, TransUnion. They use the same 5 factors for credit scoring, and I'll share those details with you, but the math's a little different. So you will see variation. And particularly, you're going to see variation on credit reports if you've done anything that had to do with a Vantage score. So Vantage scores provide a lot of good detail and information, but they are not used for lending decisions. So we'll differentiate between how these scoring models function, how they work, and why you're seeing variation in your score. But here, what I want to point out again is that within the market, the three credit bureaus are purchasing that, or are using this information. You are able to purchase, others are able to purchase and utilize the data. Credit scoring is one of the fundamental parts of the report itself, as you know, particularly when you're applying for credit. So let's take this theme a little bit further. I've talked a little bit about this, but again, the bureaus collecting and compiling information, so much data there to be able to we want predictability within financial markets. I mean, where we don't have predictability, we have significant problems. So we're talking about money and transactions that are made, internationally, regionally, locally. We need information, again, that's timely and that's accurate. And then we also want to be able to have some type of predictability about you and me as consumers, so that when a credit union or a bank lends money, again, we want that to be a decision based on risk that we know that there's a likelihood of those debts being repaid. So these reports are extremely important within the financial market. I think sometimes when we say, oh, my credit score was bad, I got rejected, we think about that in very negative terms. But switch roles for a moment and think about how quickly an institution with any amount, a large amount of money, could just go broke by making lending decisions that are just high risk, and not having the ability to actually predict likelihood of being repaid. So this is where these reports being able to give us predictability, that truly expands the good for all of us. It provides a very economic function, for all of us. When these reports are accurate and timely, and we can make good decisions, that opens markets up for all of us. It serves the greater good. And just on the flip side, when those reports are showing something quite opposite, that's where we have to do some additional work to make certain we improve particular parts of the market, and so that future lending decisions can be made in different parts of the community or regionally. And then let's look at, I think it's important also to think about what we call a legally valid need to view a credit report. So you obviously have access to these reports. It's your information, so you can do this and individually look at your history. There's a lot of credit monitoring and all sorts of services provided. If you have questions about that, share that in the comments. But whether we do a soft pull or a soft inquiry, or you sign up for credit monitoring through the 3 major bureaus, that is your information, your personal history, so you're able to do that. Others have to have a legally valid reason to pull your credit report. So not anyone just goes and pulls credit reports for you. So I listed only a couple examples here. So when you apply for a credit card or some type of hard inquiry of some sort where they need that information on the report to make a decision, a lending decision. Another legally valid reason would be to sell information, so they may pre-screen for products and services. So again, this is where they use segmentation to kind of pull information on scoring ranges, those sorts of things, and sell it. Again, the idea is to expand business, expand markets, and provide us with opportunities to access to credit. So individually, you have that ability to monitor, change, add all sorts of things to your own report itself, but just know that there's a whole legal structure in place as well that protects you as a consumer, and that others do have to have either consent or there are what we call legally valid reasons to get access to certain reports or reporting information. So that's just a quick summary of how the reports function in the broader market. Now, so let's think about, what actually is on this credit report. You're in the market. Who has access to this? They use it. What information is actually, whether you're looking for a job, you're applying for a loan, you're looking to purchase insurance, whatever that need may be, what's actually on this report itself. So when you look at a credit report, and you will find this is what I refer to as that structure and form of a report. If you have it in your hand, you've printed it out, you got it either from annual credit report or you purchased it from one of the bureaus, having that report in your hand, what do you see there? We're going to talk a little bit about what's on there and what will not be on there. So personal information certainly is going to be in that first section of the report and kind of how it's structured. So, some reference to a social security number, usually the last 4 digits there. Just personal information about you, employer's name, date of birth, that sort of stuff. You'll find all that. Want to verify that when we're lending something, it is you, as you claim to be. So that's an important part. And then your accounts, public records, inquiries. So accounts, you'll see on a report of how it's structured, you'll see a lot of account information. So the types of accounts that you have, revolving or installment, that is credit cards or loans that are structured through monthly payments, car loans, a home, small business line of credit. Could be all sorts of variation on that theme for installment loan. But how much do you owe, your payment history, all that account information there, which is extremely important because that information will also, it's also going to be correlated to your credit score itself. So the account information is an incredibly important part. You'll see accounts that are in good standing, and you'll see on a report what we refer to as adverse accounts. So accounts that, these could be charge-off accounts, these could be accounts that are in debt collection, those sorts of things. You'll see all of that information listed, and also public records information, so bankruptcy, court judgment, some type of court judgment that was taken against you as a borrower for non-payment, Child support payments are listed, although they are not a function of your credit score. So I want to be clear about that. While it does show that you may make payments for child support arrears or those sorts of things, it's not a credit scoring factor. It's not included in your credit score at all. It's just part of a public record on a credit report. And then collection accounts or tax liens, those sorts of things being listed on the credit report itself, although it does function differently than the score. If you have questions about that, please let me know, but just trying to share broadly what constitutes a public, or what defines a public record. And then inquiries. Most of us, if we've been involved in credit scoring for a while, know that those hard and soft inquiries, you'll see lots of inquiries listed. All of those inquiries, they come with different sets of rules. But when you look at these four fundamental categories, these are going to be these are four of the primary areas, core areas really, that are part of that report itself. So whether you look at any of the three credit reports or the credit bureaus and the reports that are generated by credit reports, this is the information that you will find in addition to anything you find from annual credit report, which really is, again, just all three bureaus giving you the information. So this is the core elements that you find. Now, I get a lot of questions, so I wanted to, some frequently asked questions, I wanted to share those with you as well as we think about credit reporting. You know, why aren't my accounts listed? Why aren't all my accounts listed on my credit report? Well, again, I talked about this earlier, but you know, not all lenders are going to report to all three of the credit bureaus. So, you know, you will find this, whether a service, line of credit, you may not see any of that on your credit report until it's a delinquency. They didn't report anything there until you owed money or it was a charge off. So they may have only taken action against you at the last minute when something was an adverse account. So they're reporting you for debt collection purposes, or they're reporting you because of non-payment. And again, you'll see information here, talked a little bit about this earlier, but some are going to only report to one or none at all. Usually we're going to report to one. And it's not consistent. You know, you may report to Equifax or TransUnion, vice versa. Just depends on who that lender is, who that creditor is, and what their reporting standards are. Where this gets a little tricky is closed accounts. So an account that was in good standing that was closed generally is going to fall off after 10 years. So, but there, you know, when we say 7 to 10 years, that kind of broad line is really, this could be a statute of limitations on debt collection question. This could be a bankruptcy. So there's some variation there. This is why when we get into these kind of finer details, I would ask that if you do have these kind of questions, you know, about disparities between the three reports or making sense of that, while I'm trying to give you some broad information, if you have any questions, you can always contact me at Trinity, and I work closely with the credit union. Going to refer you back after we kind of help you through some of this process to get you pre-qualified and help you improve your score. But I hope this does help you understand that, you know, when we look at those kind of disparities, the rule is basically they may not report at all or to one. So again, talked about this theme, but very important for us to stay kind of active in this process and monitoring our history through time. So what are the differences between the three bureaus? Okay, again, talked a little bit about this earlier, but each of the bureaus operate independently. So give you an example. You want to initiate a credit freeze. You've had some type of issue where maybe you think it was something had to do with fraud. Maybe you just overextended your credit and you want to pause. You want to initiate a credit freeze. We don't want anyone else gaining access. We don't want this to be a segmentation question. We don't want any of that. We just want to freeze everything. We want to be left alone for a while. Well, you're going to have to communicate across all three bureaus because they don't communicate with each other. So if you initiate a freeze with TransUnion, you know you also have to initiate that freeze with the other two credit bureaus. So what we often find too is if you dispute, you're going to have to dispute that across all three. So those three bureaus, there's a regional difference, and I laid out that historic difference through time and why we have those three bureaus. But the point I'm making here is while we have three and they operate now nationally, you still have to make communication unique to each bureau. So it's your responsibility to contact them if there's any issue on the credit report itself. Which of the three bureaus is the most important? Sometimes I get asked that question, you know, is there one that's more important than the other? No, they're all important, okay? For lending decisions, again, we can do a tri-merge. They're gonna look at, there's gonna be different rules for individual lines of credit. I know small business loans are gonna look at, they'll have certain standards themselves. You'll have to, you know, if you're already a small business owner, you're looking at the DUNS report. So these reports, there's not one that's more important than the other. Anything that's inaccurate or wrong or that needs to be addressed, we want to make certain that we take care of that information across all the reports that will be used either to make, you know, some type of lending decision on our behalf or our future business, whatever that may be. So we always want the attitude that one's not better than the other. We need them all. And if there's anything that's incorrect, we need to correct it now. And then which of these three bureaus is the most accurate? Okay, well, the law says that they have to provide, you know, under the Fair Credit Reporting Act, which I'll share with you, you know, it applies across all bureaus. So accuracy, fairness, and privacy. So these three bureaus, again, there's no credit bureau that is better than the other or which is more accurate. We are expecting certain things, again, because of the rules, that we may find something on one report and not finding on another. So accuracy is where we monitor and make certain that, you know, things are timely, up to date, our payment history is strong, or if there, you know, in particular, if there's anything that's incorrect on that report, we want to correct that across all three bureaus. So, so that's just a summary of some of those items about how it's shared in the market, what collection practices are used, how it's disseminated within the market, how it's used. Now I want to talk a little bit about what's not on a credit report. So I think sometimes we have the idea you would, you know, salary, employment status, marital status, assets, 401k. I've listed just a summary of things here that's not on a report. So when we think about credit reporting itself, you know, our active open accounts, those accounts that are in good standing, adverse accounts, kind of shared all that. But when we think about either scoring or other lending decisions that are made, what is not part of that report itself when you look at the structure of a credit report? So how much you earn is not there. So one of the things here is what we're looking at is how accounts are used. So when we think about credit reports, when we look at the account section, you know, it's not going to talk about how much money you make. So a person who is, you know, making over 100,000 and a person who's making 50,000 or below, credit scoring should be a function of how you're using the accounts that you have, active open accounts, your history. You know, how do you use those accounts through time? Now, lending decisions, you know, we have what's called the, you know, credit debt ratio. There's sorts of ratios that we use to make lending decisions that are not on the report, but just strictly looking at the report itself. Salary is not one of those issues. Your employment status, you know, what we're trying to do is have an objective way of looking at employment, not looking at someone who is, you know, has professional degrees and highly credentialed as opposed to someone else who is not. Credit reports might have some information about employment, but it's not used for any type of lending decision necessarily on the report or a function of the report. And then that would be the same for the last three bullet points that I have here with your marital status and your assets or 401k loans. You've borrowed, that information doesn't show. Assets, retirement accounts, those sorts of things, investments, none of that stuff is on a credit report. That's something that is outside of the reporting standards. So I thought that was important just to kind of lay out some of these pieces of information. I think salary is the one I get a lot of questions about sometimes. It's kind of assumed that that might be part of a report, although it has no, or even employment status. That one's often kind of a common question too. Why does an employer want to look at my credit report? What kind of information are they digging around for? But what we know is that the employment status itself, these types of pieces of information are not used for scoring, and they're not used in the report itself for any type of lending decision. Now, what is going to be shown is these types of accounts here, and I'll just quickly run through these. So when we look at the account section itself, again, revolving installment accounts, these are the two big ones. So revolving, just think about your credit card market generally. You know, anything that has to do with the credit card market, we call that revolving accounts. So installment loans, lots of, you know, whether it's a mortgage, student loan, car loans, lots of variation again on that theme. Service lines of credit. This functions a little bit differently. Installment, revolving, those are the ones we see most often because those are just those hard inquiry type loan decisions that they're score based. Service lines of credit, we typically don't see that reported until it's probably an adverse account. So it's sold to a collection agency because of non-payment. So think about cell phone bills or cable bills, any of that sort of stuff, something that's service lines or service related. Oftentimes that will come up much later and be reported after the fact, but it's not necessarily going to show the same way in payment history. It will not show as a revolving or installment line of credit. But these are the types of accounts that you will see listed on the report itself. Now, I talked earlier about segmentation. Now we're kind of transitioning away from personal information, our basic types of accounts, getting into a little bit now of that credit report, not so much of how it functions, but the other details now about the scoring side. I won't go into great detail here, but as you know, scoring is a big part of the actual report itself. So when you purchase a report or you generate a report, oftentimes we want to know what the credit score actually is showing. So when we think about reports, the credit bureaus have all this information. They take all that information and they create what, when they do the analysis, we refer to it as segmentation. So where does your score, where are you in this larger segment of similar scores? So basically, we start to put this into tiers, and I'll show you in a few minutes what we mean by those scoring ranges. But credit segmentation allows us to cast this wide net again and kind of take this big chunk of data and break it into small segments and place you within a certain area. And that's going to determine, you know, the type of prices that you pay for insurance coverage, your interest rates. You know, if you're in that private student loan market, that's going to be a function that of the market itself, what's your credit score, because it's credit score dependent. Auto loans, any of this sort of stuff where it's lending decisions are being made, segmentation is going to be a big part of that. So where do you fit in the broader market, and then what is your score range? From segmentation, what we're doing is we would know that if you see at the bottom of the slide here, so we're looking at this range of 300 to 850. This is the beacon score that I referred to earlier. We want predictive value. So when we think about segmentation, what we would say is anyone with 800, if you're in a segment that's 800 or higher, you know, you have exceptional credit. So the likelihood of delinquency or default, absent something terrible happening to your health or something else, we would assume if you're in an 800 range or you're segmented within that range of 800, you have exceptional credit, we're going to loan you a lot of money. Okay, and then you can start to see where this starts to go as it goes downward. We're looking again at we want predictability in the market. You know, for folks that are in this 550, 570 range, it could be thin file, it could be poor practices. That's where we get into the scoring stuff that I love to try to help you raise that score so that you can be in a higher segment, get the type of loan that you need. But you can just kind of scan the slide and you can start to see where, you know, again, we take the aggregate data. We start to segment it. This tells us where we fall within what's good, fair, poor, and we break the market up. And then that has a lot to do with your interest rate and the cost overall of borrowing, all from the credit report itself. I talked earlier about the Vantage score and these FICO scores. A FICO score, a Vantage score is a FICO score. I'll shortcut this for us. If you're looking at Credit Karma and some of the other sites, they generate Vantage scores. It is a FICO score. The key here is that Vantage score is not used for lending purposes. So there's lots of good that still comes from using a Vantage score. You're becoming more educated about the scoring process, but it's not. It becomes a valuable tool. It's good for education. It's good for you to start having, different practices and working on your score, but it's not used for lending purposes. So I always encourage folks to just go to the 3 major bureaus, contact me. I can work directly with you to pull a report. We pull Equifax reports. It's the most widely used for lending purposes. So if our score is strong through a Beacon score, I know your score is going to be strong across the other bureaus, so we can always look across those bureaus to do that. But the Vantage score does operate differently. And again, if you have questions about that, just please put that into the comments and we'll answer those questions for you. But for our purposes, just differentiate between these 2 scores. As you look at a report, if you're looking at anything that has to do with the 3 major credit bureaus, we're looking at, particularly these 3 approaches here. Beacon, the classic Experian FICO, the 330 to 830. So these are those 3 scoring ranges that I talked about and how they differentiate themselves in the market. And then the baseline points that are all made up. So all 3 of these models, even the Vantage, is going to use those 5 factors. Remember our good friends Bill Fair and Earl Isaac? Here it is in practice, okay? This is those 5 factors that they created in their early credit scoring model that are still with us through time because of the predictability. So payment history, outstanding debt history, and inquiries, types of credit, those 5 factors. And we've done a pretty deep dive on credit scoring before. I just wanted to give you a quick overview of those factors, again, for folks who are joining us looking at credit reporting. But again, a lot of predictive value from these. As we know, those 3 numbers right there, they mean a lot. I'll walk you just very quickly through some of these factors again. In a credit report, payment history is going to be your number 1 factor. So whatever accounts that you're looking at, if you've had anything that was adverse through time, first thing we're going to be looking at is improving payment history. So if your report demonstrates a history of late payments or anything like that, we're going to be looking to improve your payment history. These are all credit scoring questions. Any questions on that, please let me know. I'd be glad to help you. Or if you are looking to improve history, contact me. That's one of the areas that I love to work in is scoring. Be glad to help you improve your overall report. Outstanding debts. This really gets into what we look at in terms of the credit debt ratio itself. So I talk about the 30% rule. So if your accounts, if you're carrying, if you're nearly maxed out, so let's say you're close to 100%, you're carrying a high balance, we got to raise that score. We're bringing it down below 30%. We've talked a little bit about this in the past with scoring, but again, another factor that can really bring your overall score down, having a high balance. Length of credit history, there's rules about that as well. Inquiries, this is that section on the report that we talked about with hard and soft inquiries. Specific rules that we've listed here, car loans, student loan, or home loans do operate a little bit differently. But hard inquiries, soft inquiries, this is where you can monitor the credit report itself, your personal information. Soft inquiries is where, even if I'm polling, we're looking at soft inquiries. Hard inquiry really is folks you're asking someone to loan you money. All that information, again, is listed on the credit report. And then the credit mix. And this is where I talked about those accounts and the types of credit that will be reported on a credit report, being revolving or installment or different service lines. this is where we get into the types of accounts that we have, what's being used. It becomes very important for larger decisions, larger financial transactions. So credit mix, if you only have credit cards and you don't have some other kind of car loan or something through time, we've got to do some work on your score. Credit mix becomes important. So, but those 5 factors you will see through your account information. So that's all built into your score. And scoring becomes, again, one of the big questions for credit reporting questions. Now, what's not included in that score? So in a similar way, we talked about, information that's not used or listed on the credit report. You'll find some of these same factors that are not in the scoring model itself. So I thought you might find this valuable as well. So demographics, race, color, religion, marital status, similar. Law prohibits those factors being there, as well as public assistance. Again, we want to make decisions based on how accounts are used. The law requires that to be done. Fair Credit Reporting Act requires that to be done under certain standards. They're not going to look at race, color, national origin, sex, those sorts of things. Similarly, we're not looking at your salary, occupation. You'll see some of these listed again, as you did earlier, tax liens. This becomes part of public records section, but it's not in your score. So I want to be very clear on that. If you do see a civil judgment or other non-bankruptcy, some of these have been taken off reports, but they do not impact the score itself. So bankruptcy records certainly will be, but those required 7 to 10 years, depending on what chapter you filed. But tax lien, civil judgments, or what we call non-bankruptcy public records, it does not impact your score, although you'll find some of this information listed on the report. And then the most recent one that was just put into practice is bans on medical bills on credit reports. So I think it's anything below $500. It's banned now from being put on as debt collection on a credit report. And it's not a function of credit scoring at all. So if there's a collection account of some sort that went through insurance or medical emergency, whatever it may be, anything, it bans medical bills. There's rules on that. I'm still learning some of these rules myself, but it does ban medical bills from being used on a credit report or for lending decisions. So lots of information there for us to take in as we think about these reports. I'm going to close here with just some of the legal protections, and then we'll open up for questions. It's important when we think about credit reporting to also know a couple key things about some of the larger. I didn't list, this is just a kind of a summary of what I consider some of the more important parts of the law. But the Fair Credit Reporting Act, this is the one that emerges in that timeline from earlier around the 1970s, which is accuracy, fairness, and privacy. Now, when we think about those 3 terms, accuracy, fairness, and privacy, that has a lot to do with all sorts of variation and modifications of the law. I laid some of those out for you here. So you think back again, 1970s was a period, of really of heightened consumer protection. So you'll see this in the car market, credit market, really taking a look at consumer protections in that period. So disputing information, viewing, correcting records. And then the Fair Credit Reporting Act has been amended, and it changes through time, particularly when there's been something that has been a shock to a financial market. So Fair, Accurate, and Transactions Act. We look at the Wall Street reforms, consumer protection, the CFPB. This is when the housing market tanked in 2010. What we call the disclosure box. If you look at a credit report, if you look at your statements, you'll see a little box there with interest rates, those sorts of things. It's risk-based pricing. Easiest way to say that is it's going to start to be more clear about disclosure, and then being able to put a security freeze or fraud alerts. All that rooted, again, through history and time, really from this Fair Credit Reporting Act, accurate and timely information. And then a couple of other ones. I won't go into great detail here, but just again, things that are it's kind of the legal structure around these reports. Things are not there by accident. Okay, there's a legal structure, there's a process. We have a structure and form of those reports. So a lot of information here today being shared with you about the report itself. Truth in Lending Act, another part of this that kind of shapes credit reports. We don't want to use deceptive language to steer folks into higher products and services. So we want that. That's part of that accuracy in lending, being able to easily understand the terms and what it is that you're doing when you borrow a certain amount of money, being clear about what that is. Fair Credit Billing Act. This is where you'll see your statements itself 21 days before payments are due. So we know we have timelines that are predictable. So things are not moving around. So folks are charging us fees, or we want predictability again in the market. Fair Credit Billing Act is able to provide that legal structure for us. And then on the debt collection side, again, nothing there by accident. We're looking at predictability within the market, even when it's a bad debt. So there's a lot of work that goes into Fair Debt Collection Practices Act, but having a process in place that if folks are calling your employer or threatening you, calling you between 8 and 9 p.m., process there that is basically to make sure that the folks that are trying to collect on these sorts of things are not becoming a burden to your employer, to you, or trying to take deceptive practices against you, even at your worst, when you are not able to repay or had some type of hardship. So a lot of rules around that as well. And then finally, I mentioned you can always contact the credit bureaus if you've had any type of I've listed some of the key provisions here when you want to obtain a report. So when you're thinking about identity theft, a fraud alert, we can always obtain that information from the credit bureaus. And then you have the right to dispute, to initiate a freeze. Some of us have talked about these issues before, but if you want to contact the bureaus, I've listed the 800 numbers for their customer service. So if you want to initiate a freeze or dispute, you're simply calling the bureau and then asking to do that very thing. But these are the phone numbers for you to contact them if you have questions or want those types of services. And then lastly, you have me. If you want to have me help you with a report, give you additional information, run a credit score for you, that's why I'm here. So we have had quite an hour of lots of details on reports, but I hope that helps you make sense now of the history and how these reports function and how it's all tied together, so that you have a better understanding of reports and more confidence in yourself as you evaluate those reports. So Kelly, if there's any questions, please let me know.
Yes, thank you, Todd. We'll go ahead and open it up for our Q&A session. I know there were a couple submitted, so we'll go ahead and jump in with the time we have left. But if you do have a question, go ahead and submit that. And if we don't get to it in our remaining few minutes, I will send it over to Todd and we'll get that question answered for you. So Todd, our first question says, could you speak a little more on what credit freezes are and some of the pros and cons to doing a credit freeze?
Yes, well, a credit freeze, basically, the concept here is just to make certain that you want to essentially lock anyone else out of having access to your credit report at all. Okay, so a credit freeze oftentimes initiates from you being concerned about someone using your information, having access to your information. Sometimes it's initiated because you are concerned about fraud or theft. But a credit freeze, the basic concept is if you don't want a lender, an employer, or anyone else to look at your credit report, you're just locking it up. You're freezing all access to that credit report. It's done, again, where the pro is that if you are concerned about any type of misuse of your credit in any way, then you essentially lock it out of access. No one can gain access to that report at all. So that is a pro. It doesn't allow anyone to take advantage or to misuse your information for any type of decision that would be used. The downside on that is, well, one, if you're going to effectively use a credit freeze, you have to do it across all three bureaus. Again, the bureaus do not talk to each other. They don't communicate with each other. They operate independently. So you have to do some of that work on your own to initiate that freeze. The other side is that if you're going to go into any kind of lending decision, so maybe you've improved your credit history, you've taken a lot of steps to pay off debt, that sort of stuff, you're gonna have to go and unlock that report. So if you're trying to gain access through time to your credit report for monitoring, you will not be able to do that while that freeze is in place. For example, if you contact me and you want information on your credit report, I can't do it. The credit union couldn't do it. No one can do it. It's locked down. Simply put, there's really no bad outcome from it. It's just what you got to think about, what the fundamental reason is that you're doing it in the first place. It's really done to make sure that there's no adverse action taken against you or your data is not misused in some form. Doesn't lower your score. There's really no adverse outcomes from using it and initiating a credit freeze. It's just as you go about improving your score through time, you will have to unlock the reports if you ever want to monitor your score. So if you have questions on that, just reach out to me and I'll walk you through that process. But if you're thinking about a credit freeze, again, just be careful about what it is and the reason why you're doing it.
And then our next question asks, what is the process for contacting the credit bureaus if there is a known error?
Yes, and there's a lot of statistics out there about, what we mean by a known error. So typically that's defined as duplicate, incorrect information. Duplicate accounts can be there oftentimes for debt collection practices. We don't want adverse accounts listed twice. Dinging our score twice. The process is really, it's very simple. Those three numbers that I listed in the presentation slide, if you contact the credit bureau, you can simply, from that 800 number, just contact the credit bureau and tell them that you want to dispute. So in this case right here, you call Equifax, you want to initiate a dispute. So they're going to the customer service line will ask you, okay, well, what is it that you want to dispute? You're going to you tell them the account, they will just initiate that dispute. It takes literally a couple minutes to do it. If it's incorrect, again, you're disputing the accuracy. Think about the Fair Credit Reporting Act again. Accuracy, fairness, and privacy. So that fairness part, things that are just incorrect. If you see anything that you question, then you just you initiate a dispute that it's being a duplicate or incorrect information. Just say that it's wrong. And they will typically ask you a couple questions about the account, but that's pretty much it. That's the process. It's very straightforward. There's even ways to initiate it online, but the customer service line is really, you can initiate a credit freeze, you can initiate disputes, and there, again, anything that's inaccurate or duplicate, call the customer service line. They'll get the process forward. It takes a couple minutes, and then the law goes into effect. They will start. You'll usually hear something within 30 to 45 days whether that correction has been made. And I think right now the credit bureaus are running slow. So if you haven't heard back, which there are cases that have gone beyond that 45 days with kind of the current governmental stuff going on right now with Doge and other things, but just if you have questions about that, contact me and I can run a report for you, kind of help you through that process.
All right, and that is going to conclude the Q&A session for today. If you have any other questions, feel free to reach out to Todd directly to get some answers to those questions you may want to address offline. But with that, that is going to conclude today's webinar. Thank you all so much for joining us and have a great rest of your day.